Hi, everyone. Welcome to another VSG Oceanside chat. We have a pretty big group today, so I'm just going to reintroduce myself to those who know me and introduce myself to those who don't. My name is Arcelia. I manage programs and operations for the Viterbi Startup Garage, which is USC Viterbi's unique incubator out in the marina for early stage technology teams that are based in LA. Those teams are pre-seed to seed. Some of them are raising their Series A. They don't need a USC affiliation. They don't need to be students. I think that that's kind of a ghost of an iteration past. So as long as you are in Southern California and you're a full-time founder of an early stage tech team, you can apply. We just closed our spring cohort application and we've onboarded our new set of teams, but we will have another open application in the fall. So if you are a startup entrepreneur and you are looking to incubate with us, you can join our newsletter and you'll get early looks at that open application. Jumping right into the Oceanside chat, we are super lucky to have Joe Wilson joining us. Joe is a managing partner at Undeterred Capital. He has nearly a decade of experience in deep technologies in operations and investment. During his time at MIT, he founded Multiply Labs, which is a pharma robotics company. And now he manages a portfolio of more than 15 companies across applied robotics, biological platforms, and health technologies. And today he's going to help us understand how to found and fund those types of companies. So we're really lucky to have him. I'm going to pass the microphone over to him. He can Joe, lean into your bio if you want a little more. I sneaked a little bit of information from your LinkedIn. I know that you've had some experience with Y Combinator. There's probably so many other things that you can talk about, but I'm just going to pass you the mic. And if you want to share your screen, I'm not sure if you have a deck for this presentation, you could do that too.
Sounds great. And thanks for the overview. So yes, let me, I'll start sharing.
Looks good.
All right. Excellent. Well, again, thanks for having me on. I want to start by saying I think that we probably have people at a lot of different stages, whether it's career stages or company stages. So I tried to make the presentation approachable to all, but there's probably going to be some stuff that for some of you is a bit of a review. For some, it's moving too fast. So a couple things there. One, that's kind of just the way it is. It's hard to cater to everyone. But two, I definitely want this to be interactive. So if you have questions along the way, please let me know. Please ping the chat. Arcelia, if you do see stuff as well, please call it to my attention.
Yeah, I will do. If you guys can just use the hand raise function, then you kind of queue up and I can interrupt you, Joe, at any time.
That sounds great. Perfect. So with that, I'm going to jump in. So I'm Joe Wilson, managing partner of Undeterred Capital. We are a pre-seed and seed stage deep tech and bioscience fund. What that means is, our core mandate is helping to operationalize scientific and technological breakthroughs. So almost always that is a team, whether they're associated with the university or not, that says, hey, we've done something really cool on the scientific front or the technological front, and now we want to build a business around it. So I'll get into my background a little bit more. So, I come not just with kind of, empty tidings, but I've lived this experience as an entrepreneur. I've been in the space for about a decade now and know it quite well. So what I'm going to cover today, first, I'm going to give a little bit more on my journey, kind of for some of the younger members out there today, what it was like kind of leaving my undergrad, early things I did before getting into the deep tech world and the startup world, and then how I arrived at having my own venture firm. And then I'm going to get into the two main parts of the presentation. First is founding and kind of the difficulties therein with starting a deep tech company, raising financing for it, and then scaling it over time. And then on the other side of the table, what are some of the difficulties with funding deep tech companies, and what are some of the opportunities today? And then, I have Q&A at the end as well. But again, I prefer this to be interactive. And because I can't see all of you, yes, just let me know as questions come up or interrupt, and I'm happy to go off on tangents as well. Okay, great. So to start my journey, I mentioned before, I was an entrepreneur before I was an investor. Taking it back a few steps, my journey begins when I left Duke University, where I went to undergrad. And I think like a lot of young people who don't know what they want to do, I did consulting. And so was a consultant for about 4 years, helping establish Accenture's digital practice. And during that time, just got pulled further and further into the tech industry. At first, I think it was mostly, kind of unclear what I wanted to do, but I was really attracted to the technologies that were true technologies, that were less on the software app side of the world, and much more on, okay, who's building hardware? This was, in the early days of cryptocurrencies, that was a major area of focus as well as, a lot of applied robotics I thought were fascinating, but didn't understand much about them. So was a consultant during these 4 years. It was fine. I think I have very specific thoughts on being a consultant, especially if you're younger in your career, but I think it was good out of the gate. And it also kind of convinced me of what I didn't want to spend my time doing over the next couple of decades. In 2015, I moved to Cambridge and started at MIT, where I was in business school. Before I even started, I ran MIT's startup accelerator program called Delta V, which was my first exposure to a lot of these deep tech companies, and to thinking through, what's the best way to continue to make progress in the science front and de-risk from that perspective, but also what are the effective ways to actually commercialize some of these technological breakthroughs, how to get them out of the lab and into the hands of customers as quickly as possible. So I ran that program in summer of 2015 and made it about 6 months into business school before I started my own company. And that kind of moves to the second half of this journey, which is I was the founder of a pharmaceutical robotics company called Multiply Labs, which I'll get into a little bit more. Took that company through Y Combinator, scaled it up, and then at the end of 2018, moved down to Los Angeles and started on the venture side, first as a partner at an early stage firm, and then eventually started my own venture firm in 2020. So on my journey, I've already kind of covered that first chapter. The first 4 years of my career, I think we're good in terms of initial leveling up, getting a perspective on what I wanted to do, seeing the world a little bit. I lived in Amsterdam for a while as well. But I think certainly the startup part of my career begins when I was at MIT. As I mentioned, in the fall of 2015, I met 2 individuals who would go on to be my co-founders at Multiply Labs. One was a PhD in robotics and another was a PhD in pharmaceutical science. And they had come up with a method for 3D printing capsules, specifically 3D printing medication capsules, with the vision of if they could print these capsules, they could actually control when certain medications were released in the body. And using robotic systems, they could then tailor exact dosages to an individual as well. And so in that way, you could create true personalized medicine via this robotic system. So, I was definitely taken in by the idea. I thought it was fascinating. I worked with that team for several months. Eventually, I was asked to come on board as a co-founder, would later become COO of that company. And at the end of that semester, so in May of 2016, we decided to spin the company out of MIT and move out to California because we had been accepted into the Y Combinator program for early stage startups. So we moved out there. The company was still very, very early. I think when we got into Y Combinator, we hadn't even incorporated yet. We moved out. We raised an initial round of funding after that summer, and we got to work building the company. So the next 3 years or so were really spent heads down building a pharmaceutical facility to create our first personalized drugs and to prove that the robotic systems work to do this personalization. So hired a team around that. And really we're in kind of the South San Francisco area, designing this construction system, this pharmaceutical lab to prove this proof of concept. Over the 3 years that I was there, we made just some pretty incredible advances, both on the pharma side and on the robotic side, secured some early partnerships with people who would eventually use the technology. And then at the end of 2018, the stars kind of aligned for my wife and I to move to LA, which is where she's from originally. So decided at that point to leave Multiply and begin the next journey of my career, which was on the funding side, specifically working at venture firms to invest in early stage companies. Now, I'll say me joining, the first venture firm, which was called Mars Bio, it actually wasn't because I wanted to switch careers or join. It was more that, these early stage VCs saw a lot of interesting companies. So I thought, great, I can work for this venture firm and find out what company I want to either start next or join next as an exec. But on the way, I got hooked by the venture side. And I think some of the obvious ways I got hooked was it's great to have a job where what you do is meet with the smartest people in the world. And they get to tell you about how they're going to change things. And that's easy. Everyone enjoys that. But I think some of the more mundane aspects I was also very much drawn to. I thought they were, there's a lot of non-fun parts of venture that I still enjoy quite a bit. And after about a year at this venture firm, decided to start my own. And the reasons for that were twofold. One was, as an entrepreneur, we had some great investors at Multiply Labs, but there weren't very many who knew the playbook of scaling up from founding a company all the way up to raising that first, what's called the first institutional round of capital at the Series A. So that first 10 or $20 million, there wasn't really a playbook. It was kind of, that seems like a good technical plan. Why don't you do that? And then see if anyone buys the story at the Series A. And that just felt like a kind of an incomplete way to go about it. And I had built a company, I had worked with and mentored many companies as I was building my own, and I knew that playbook pretty well. And I thought that should be out there. People should know about it. I think I can help companies de-risk, especially commercially, as they're spinning out of a university or they're starting to scale up. So that was one big reason I started Undeterred. The second was, I thought in 3 particular industries, there were some massive tailwind effects that were going to increase the opportunity scope in these industries. And those 3 areas were the 3 that I focus on, which is health technology, biological platforms, and applied robotics. In each of those cases, I thought there was massive potential. Some of them have gone through hype cycles before where the tech didn't totally work, or the customer segment wasn't willing to wasn't ready to start buying the tech. But I thought each of them had hit really interesting inflection points. In addition to that, I started the fund in the early days of COVID. So this was also when the pandemic was accelerating a lot of these research and development areas. Funding was flowing in, non-dilutive funding was available for a lot of these tech companies that wasn't available before. And I thought, great, I think this is going to have an impact, not just while COVID is going on over the next few years, but really it's going to lead to a seed change in startups, specifically in these areas. So with those as kind of the core 2 points, I decided to start Undeterred Capital to fill that gap and to support that early stage of company. So started Undeterred and started making investments in late 2020. To date, we've done 16 investments, all of them at a really early stage. In about half the cases, we're the first investor in the company. In the majority of the investments, I think maybe 9 or 10 out of the 16, we knew the founders before they started the company, and were involved in the first financing round. So this is, almost always, we're about as early stage as it comes there. And yeah, I guess that's a little about us, a little about Undeterred. And my journey to get to the point to get to the point I'm at now. So that was kind of a long opener. So I'll pause there. Any questions on background, on kind of what I've seen before, either on the operating side or the investing side?
Joe, I have a question. I'm Moses. Hey, nice to meet you.
Hey.
So when you, at that very formative stage, when you decide to kind of go out on your own, I assume that there's a story around getting access to capital to begin your fund and getting some LPs in and all of that, and kind of getting enough capital to launch off. What was that like for you? Was there a set of individuals who had, similar ideas about what your theme would be in your venture firm and how you wanted to do it? How did that work out?
Yeah. So I got some good advice before I started my firm, which was, if you're going to start a venture firm from scratch, you should expect to fundraise for the first 10 years. And there's truth in that on a couple different dimensions. I think first is a recognition that raising for a venture fund is way different than raising from a startup. Raising from a startup, if things are going well, you can typically raise an early round in anywhere from a couple weeks to a couple months and then get back to work. The vast majority of venture funds take 1 to 2 years to raise, if they get raised at all. So it's a much longer process. And the way it also works is, given the cycle time, basically when you stop raising your first venture fund, you're basically starting to raise your second. So there's really no gap until you reach, fund 3 or 4, which is normally about a decade in. So that was the first piece of wisdom that I kind of internalized before I went to start my firm. The second thing is, yes, it's the people that backed me out of the gate, that back most fund managers out of the gate, are definitely starts with closer contacts. Whether those are firms or individuals who say, I think there's something special about this vision, I want to see where it goes. Or there are groups who provide kind of early seed capital to help get managers off the ground. I was fortunate to get a little bit of funding and start making those early investments. But yeah, it certainly wasn't an easy process. And I think especially now, I think fund managers who are trying to create a new fund in 2023 with the market the way it is, it's certainly a challenging thing. Oh, I think you're muted, Moses.
Yeah, I mean, this is, and I was going to ask, that was my follow-on question, was what's the impact of this? We've hit this inflection point in our economy where cost of money is now expensive. It's no more free money, right? So, so we've got, the Fed rates at, I don't know what it's at now, 6%. And, when you buy money and, you put it to work, everything is starting to slow in the venture world. What does that mean for you, in your view, as a venture fund? And what do you see as the impact, the shorter or longer term impacts of that with regard to venture?
Yeah, I think for venture as an industry, I think it's going to wash out a lot of younger firms, less established firms. Because the reality is, I mean, a lot of these small firms, they can't survive very long without new funding, right? If the market downturn lasts too long, they can't really go on. And so I think we'll see some consolidation there. I think some smaller firms will probably combine forces. I think people who are doing 2 jobs, who are running a company and running a fund, I think many of them will end up just running the company. I think that dual focus will stop. Paradoxically, it's really interesting, right? Because as the market gets worse, the valuations become worse. And so if you are a believer in venture as an asset class, and if you do believe that a manager has access to some of the, multi-billion-dollar companies 10 years from now, this is an amazing time to invest as the prices have come down markedly. But again, like, you are competing against 5-6% interest rates, as opposed to, and so there are different sources of where those funding dollars can go. I guess like the last thing I'll say on this is, it's always worth keeping in mind that potential investors in the fund, potential limited partners, normally they think in terms of buckets, right? They have a bucket for private equity, they have a bucket for public market positions. They have a bucket for, for keeping cash positions or treasuries. So the largest groups, it's few of them are going to be like heavily downsizing their venture portfolio so they can put it in cash or they can put it in treasury. So it is a little bit more fixed there. But the last kind of difficulty is for a lot of groups that did scale up their positions in venture massively, they're kind of sitting on their hands because they've got plenty of venture companies that are later stage that either aren't raising new rounds or where the price is maybe a little bit too expensive. And so that's leading a lot of larger limited partners to hold deployments to either new managers or even to existing relationships. So a long answer to a simple question, but I do think there's plenty more turbulence ahead on the manager side.
Sure. Thank you.
We have a couple questions from the group. One of them is from Detravius. Take it away.
Yeah, hey Joe. First, thank you, for this presentation. My background is in computer science, and so I know you mentioned earlier about like early stage funding or like something like Series A. I'm not sure if you want to touch on that now or if we should wait until you get to like the funding slide.
Yeah, I mean, happy to discuss it either way. So specifically I had a question pop up right as you were speaking. You're saying funding for the Series A?
Right, yes. And then other types of, I guess, funding options as well.
Yeah, absolutely. So certainly there have been more non-dilutive funding options that have come about over the last few years. So we've seen some startups take advantage of, government grants, NIH funding. There are more and more opportunities to apply to those sorts of grants. And it used to be that the amount was kind of limited, right? There'd be a 5K grant here or a 10K grant here. We're seeing multi-million-dollar grants out there for companies that are working on, either breakthrough science or really interesting technologies. So that's becoming more and more possible. Traditionally there have been, over the last decade, there have been more financing options on the debt side of things. So if you had a sustainable business model, you could lend against that. And there were more financing options that way. I would guess we're going to see less of those over time. With the current market, I think a lot of those offerings are being pulled back, at least in part. And so, there's a greater reliance on either non-dilutive funding or, more traditional kind of venture financing. The last part on venture funding and on kind of the Series A is the market has certainly gotten tougher there. Certainly for established companies. So if you're talking a Series B round and beyond, those rounds are super tough to raise right now. They're not a lot that are being done in this current market. And the ones that are very, very battle tested, sustainable businesses. At the Series A, there are plenty of deals still getting done. We've been fortunate that in our portfolio in the last quarter, we've had two new companies raised at that round, but they're definitely taking longer. They're requiring many more conversations with investors. Investor conversations are taking months where they used to take weeks. And there's certainly more non-traditional partners in addition to venture capitalists who are investing in those rounds. So the dynamics of the rounds have changed. I think the valuations have come down anywhere from probably 20%, 10 to 20% on the Series A side. For later stage rounds, a lot of those prices have come down, 60 or 70%. So it's certainly not a great time to be fundraising. At the pre-seed and seed stage, I would say that the funding, it's difficult to fully close a round, but there are still funds that are deploying at that stage. I mean, we've been super active this year. I know there are a number of others that are investing kind of aggressively at this time, because again, you're investing on a 10-year time horizon. So you do have time for things to turn around on the public side. I hope that answered your question, but let me know if there are other follow-ups there.
Yeah, just one follow-up right quick. So then in terms of, you mentioned like, pre-seed, seed stage, Series A, B, I guess what are like the differences, or is it, I guess, where the company is at in terms of like development wise, or?
Yeah, that's exactly right. So
okay,
you start a company, the first round of funding It kind of depends. Sometimes you'll have like a friends and family round where you're raising tens of thousands of dollars, maybe low hundreds of thousands, but it's mostly just enough to maybe put like a minimum viable product together, do some customer interviews just to prove maybe this idea is worth pursuing. The first kind of, it's called institutional round, is at the pre-seed. That's where we play a lot in, but most of the time, maybe you have an early prototype, maybe you're working with a few initial customers, but still a lot that's kind of undecided. Those rounds are anywhere from $500,000, maybe up to $2 million at the biggest. And that's kind of the first round of the company. Seed round, typically you have, if you're a kind of traditional SaaS company, you have some early customers, you have a product. If you're a deep tech company, you may have an early prototype. If you're in the lab, you've maybe gotten past the bench scale. And those are a little bit larger. Those rounds can be anywhere from $1 million up to about $5 million. And each successive round is just either greater technological readiness and or greater commercial traction. So by the time you raise your Series A, the vast majority of companies will be generating revenue at that point. And then it's just about how much are you generating and how fast are you growing. And then the later stages are really just a function of growth and revenue. So do you have 10 million in revenue? Are you tripling your sales every year? Those are some things that investors will look for. It becomes more of a math problem at the later stages, whereas early stages, you're diligencing a lot more on non-financial model problems.
I see. Okay. Yeah, that answers my question. Thank you.
Of course.
We have a few more questions, 3 to be exact. And actually, I have a question, but let me pass it to Selena.
Thank you, Arcelia. This is my second time. I love your Viterbi's Zoom events. I'm an online MBA graduate student in the summer. I've been planning my startup for years and looking for different funding. And I have friends got into YC, everything. So I know all how they play the games. But one question for Jeff. Thank you for sharing so much. I love your stories. I love your PowerPoint. We love to have it if you can share later. But what is your venture capital's name meaning of your company? What's the meaning of your, how did you pick Undeterred? I'm just curious.
Yeah, so venture firms have different ways of viewing who their customers are or the groups that they're trying to provide service for. For us, it's our founders. And so when I picked our name, a big question was, what are the values we want to signal to founders and what values are important to us? And for many of the companies that we back, these really early stage companies that are often, researchers who have been working on problems for up to a decade, what keeps them going is their psychology, is their kind of undeterred nature to continue to push through these hurdles. And so we thought that was a useful word to leverage. We thought that represented the sort of founder we wanted to back. These aren't founders who one day they're doing, one flashy thing and the next they're on the next hype train, but they're really trying to make their business work regardless of the obstacles. And so that's one of the major attributes we look for in our founders. And we thought that we wanted to reflect that in the name as well.
That's very smart. I think I can understand it as you choose founders, or which is most important, is tenacity to deal with difficulties. That's why it's Undeterred vision.
Exactly. Yep.
Great, thank you.
So funny that was your question, Selena, because a part of my question was going to be to apologize for having said it was underrated capital.
I thought same thing too. So like underrated. So why? Like acting.
Use this as an opportunity to apologize. And actually, I'm going to cut the line just because my question is a little bit of a dovetail. You were mentioning that part of the impetus for creating this venture fund is because of the lack of support in those kind of like early stage developmental funds. And I'm wondering, from your experience, do you feel like that is because there's a ton of misconceptions about what it takes, or is it just one of those things where it's like, those are the minor leagues, we're the major leagues, let us know when you're ready to play with us? Like why is there such a huge divide? Why do you have to exist, right? What's the issue there?
Yeah, I think it's I think the problems aren't really obvious, right? I think when I decide to partner with an entrepreneur, right, they are without fail, brilliant people who know their idea and their technology inside and out. So it's rare that they come to me and say, hey, we need help on the science side. But I think like the method of scaling a deep tech company, a lot of times it's not intuitive. If you're working on a specific technology that's going to be used in manufacturing lines, for instance, many first-time founders say, well, maybe we should have our own facility to really show off how the technology is used. And that's what we did at Multiply too. That's almost always a mistake. It requires a ton of capital, takes a long time, and new investors don't really care about it, right? Like they just see it as a massive capital drain. And so, I think things like that are maybe not intuitive if you're building a deep tech company. And also understanding the other part is deep tech companies do require additional rounds of capital. It's really difficult to bootstrap a deep tech company because you need capital to perform R&D before it's ready to sell to customers. And so as part of that, a Series A financing is pretty critical for a lot of these companies. And so knowing what those type of investors, those Series A investors actually care about from a technology point of view, from a commercialization point of view, it's not written down anywhere. And so I do think that you need that context of having operated. Like for me to look entrepreneurs in the eye and give them advice, I need to say, I've been in your shoes before. These are the mistakes I made. If you make this choice, this is what you'll have to deal with. If you make that choice, this is what's going to happen. And I think that practical advice just doesn't exist in a lot of really early stage venture firms.
Got it. Hopefully you'll share some of those mistakes with us later down the line. I'm going to pass it over to Christina and then Tom. And then just for the sake of getting through this, I'm going to cap it there so that you can get back to your presentation, Joe.
No problem.
Christina, go for it.
Thank you so much, Joe, for sharing your entrepreneurial journey with us. You have a really impressive background and yet you're really humble. So thank you for that. I really wanted to know more about the Y Combinator experience. So given the competitive landscape of Y Combinator, how did you convey your competitive advantage to the judges? And I know that it's a really rigorous screening process. So how did you go about that? How much preparation did you spend most of your time on? And if you could go back in time, what would you tell your younger self?
It's really interesting. So I think first I would say I absolutely recommend Y Combinator. We've had a handful of our portfolio companies have gone through that program and have been really successful. When we applied, again, we were really early stage. We hadn't even incorporated. We spent a ton of time on the application. We refined our application. We shared it with alums who had gone through Y Combinator. We got feedback that way. And then once we got an interview, we probably did a dozen or 15 practice interviews because the interview process itself was and maybe still is extremely a very different experience. It was 10 minutes of rapid fire questions with 5 YC partners. Now, I don't know what's changed. We did it in 2016, so that's 7 years ago. Batch sizes are bigger now. I don't know what happens in the interview rooms and how that's different. But I certainly don't regret kind of preparing to the extent that we did because, there's nothing at that time, there were maybe 70 or 80 companies that got into Y Combinator for each batch. And it really was a ticket to an accelerated company to access new funding. And so we put our full effort into getting one of those tickets. And fortunately, we were able to do so. I will say the program itself was excellent. We raised about $2 million afterwards. What I always tell people is, I think Y Combinator probably accelerated our efforts by anywhere from like a year to a year and a half. I think if it would have taken that additional time to raise capital if we wouldn't have gone through Y Combinator. So it was really useful in that regard. And I'll say, 3 of our current portfolio companies have founders, or a quarter of our companies now have founders that I knew back during Y Combinator, who I'm associated with through Y Combinator. So the network has been super valuable as well for me.
Great.
Thank
Tom.
you.
Nice. Hey, Joe, Tom Humans with Roman Aerospace here. Really appreciate your time for the presentation. Given being in the deep tech space and in the bio space, and given potential difficulties with firms raising rounds right now, I assume you see a bunch of teams with non-dilutive funding from NSF, NIH, potentially DoD, different kind of R&D contracts. I was just wondering, what are some of your favorite instances of companies that have this non-dilutive funding from a DoD or NSF source that are showing the future commercial potential of a technology that might not right now be in the R&D or the DoD phases?
Yeah, so yeah, I guess a couple examples. So I can't fully share current companies who have access to those funding because it hasn't been publicly stated yet. But I will say we've got one company in the biological sciences that's been able to tap into a few $1 million via government agencies, which has been amazing for their initial scale up. I think one company that's done it super well historically is a synthetic biology company called Ginkgo Bioworks. They were able to secure a number of not just government grants, but government contracts, especially in the scale of COVID, and have been very effective at utilizing that capital to continue to scale up. I think it's also important to always weigh the grant financing against where you are as a company. So I think in the early stages, it can be really critical and really important. But I think you also have to recognize that it's more likely you'll be in the running for a 10K or 100K grant early on, as opposed to a multi-million-dollar grant. Those require a ton of efforts. Often people will bring in outside consultants and require, kind of a clear mandate from the governmental agency to invest specifically in what you're developing too. And then you have to look at the other groups that are competing directly against you and, what technology they're bringing to the table. So that's the additional nuance too, is part of the success is not just identifying the right government groups or alternative pools of capital. It's understanding the stage that the other companies applying are at and whether you kind of fit that bill.
Makes sense. I appreciate the thoughts.
Great. Joe, you're free to move forward.
Okay, perfect. And thanks for all the great questions. Really, my slides are just supposed to spur discussion. So, we can pause as well at any point if people have others. Okay, great. So, part of this presentation, I also wanted to talk about some of the problems and opportunities, both with founding deep tech companies and with funding them, right? So when you're founding a deep tech company, there's a few things that, and this also probably gets to Arcelia's point on, why your fund exists, why your firm exists. But there's a few things that people are going to ask from the get-go, especially in this market. So the number one question or concern that I deal with companies that are spinning out from a university specifically is the technologies are always fascinating. They're almost always bleeding edge. They're doing stuff that no one else has done before. They're in nature. They're in all these other areas, but they're very much a solution looking for a problem. They're technology, but it's not always clear what problem they're solving and how that can be commercialized. So that's one thing that, if I'm having office hours and I'm meeting with entrepreneurs, that's almost always, one of the major feedback points for early teams. Second one is the market uncertainty, and require specifically, this is the biggest thing that neutralizes promising tech. So even if you've identified a problem, the market needs to be big enough. And it's not just that the market needs to be big enough. To build a deep tech company, there needs to be a slam dunk response to how big is this market. And if you're successful in building what you claim to be able to build, as soon as you build that, will it sell like hotcakes, right? So an example of this is, nuclear fusion, right? There have been at this point, hundreds of millions, billions of dollars put into these nuclear fusion companies. Part of the reason is it's a slammed up market case, right? If you're able to actually prove, if you're able to actually accomplish this technologically, people will want that, right? People will want that source of energy. One of our portfolio companies that I think encapsulates this quite well is we have a company that focuses on asteroid mining, specifically asteroid mining for rare minerals that are in high demand for things like electric vehicles and further electrification here on Earth. The market demand is completely overwhelming, right? And so the question is not, will anyone buy this? It's, yes, we'll buy everything available. The question then becomes, can you get it to work technologically? So that's the biggest killer. The number one reason I pass on companies is I'm not convinced the market really needs what they're building. Number three, it's too capital intensive. So this has always been a complaint about deep tech. It's especially something that's brought up now, especially if your technology involves building factories, putting together really capital intensive robotic assembly lines, anything that is in the world of atoms. It's not a deal breaker, but you just need to come up with a really thoughtful way of scaling that doesn't require huge injections of capital to get there. And that's linked to the fourth point, which is, where's the revenue? When are you actually going to be able to start showing revenue? I would say that all these points are interrelated, right? Like if the market is purely bulletproof, people will invest higher amounts of capital before any revenue is generated at all. Again, canonical example being nuclear fusion. Billions of dollars going in before any revenue at all. The further you are away from that extreme end of the spectrum, if people are unsure at all about the market demand for this, they'll expect to see revenue at an earlier point. We have some companies working on really much needed solutions in the world, but that are going to have to start showing some source of revenue early to demonstrate the market potential of what they're building. And then the last point I'll get to here before we can jump over to John's question. Big problem with building a deep tech company is there's way more ways to fail than as a software company. You can make mistakes if you're producing a physical product in your inventory, how you're storing products. Often if I'm talking to a company that has a hardware product, one of the biggest problems is like, it's rare to get the first or the second or the third version of your product right. But if you're having full production lines where you're manufacturing this product, even if you're outsourcing that manufacturing, it can be really expensive to have multiple runs of the product. And very quickly, you can be in a situation where your first version of the product isn't what you thought it would be, or it doesn't fully work, but you're out of capital. And so that there's a lot more ways to die as a deep tech company as opposed to other companies. Frankly, the research may not pan out. You may not be able to scale up. So those are that introduces additional chaos and why some investors kind of shy away from deep tech investing.
Good to see.
Happy to go to John if we want to do that.
Yeah. John is a former VSG team, so it's nice to see him.
Yeah, thanks for being here and talking. It's a great presentation. I work on a company. It's basically a biomedical imaging YouTube sort of application, and I have a question around the trade-off between chasing revenue and working on product for you. And I guess we found in our work that we were so eager to prove out the commercial opportunity that we found ourselves taking revenue jobs that we couldn't always support or can't necessarily support based on current technical capabilities or our capacity to basically develop for the client. And I'm wondering how you see that. It's great because you can develop on real world use cases and it's non-dilutive and all that, but that trade-off between working on your own to flesh out the product based on investment dollars and going quickly to find revenue opportunities, and how that balance is formed in your opinion.
Yeah, I mean, this is one of the stickiest questions in building a deep tech company. And again, is what I spend a ton of my time with founders in our portfolio on, because there isn't a slam dunk easy answer here. Part of what you're judging is if you are relying on subsequent rounds of investments to scale your company, you're betting on the psychology of those investors in later rounds, which can be tough to do. So ways to go off the tracks when you're seeking revenue. One is what you mentioned, which is you're seeking revenue that you can't really support right now. And as a result, you end up churning customers, which puts your business in a worse place. Another kind of mistake or failure case is you're going after revenue, but revenue that doesn't support your long-term business model. So specifically how this manifests for a lot of deep tech companies is they get into quasi like consulting agreements with large customers. So they'll say, these are our target customers, which they may be, and we're performing a similar function, which they may be, but it's not exactly the same. And so they end up in this kind of fee for service model, which is not scalable. And an investor will look at that and say, you're pitching me on a consulting company, not on a deep tech company that is selling a core product. So that's a tough one. That's a tough one to avoid too, because on the other side, it is really useful for a deep tech company to be showing revenue with target customers. And so you've got to thread that needle where, and I know it's probably vague in your case, but as a generality, you do need to thread that needle where, the revenue is proving what you want it to prove without detracting from your overall story. The way I think about it for some of my bio companies is, are you showing deepening customer relationships, right? Is this a pilot to get you in the door for a larger commercial deployment? If so, that's certainly more interesting than this company is paying us $100 an hour to perform this service for them, or they're buying, some byproduct of our process that isn't actually the output. Those are less interesting cases. But if you can show deepening relationship, if you can show increased revenue, if you can show automation for that revenue, so it doesn't require additional sales staff to support, those are all things that are really advantageous for deep tech companies. And then for, really long-term deep tech companies that may not show revenue for 5 to 7 years, almost always that takes the form of conditional contracts. In the early days, it's letters of intent. It's kind of softer versions of money in hand. If you're at an advanced stage, there are non-refundable deposits, right? So if you want to look at examples of this, Boom Aerospace, that's designing the supersonic jet, has done a really good job historically of, even though, it's probably going to take them 10 years to get the supersonic jet out, of showing commercial progress along the way.
Got it. That's fantastic. Thank you.
Can I add, I feel that this is a common issue with teams at the early stage. And, in psychology, this it falls under scarcity mindset where, you're really being pushed to be able to return on investment from investors. And that's usually through revenue. And if you're not pulling revenue, then you kind of have like a hyper fixation on getting revenue. And it's like a very short-term solution to what is kind of a long-term problem. I think it's a real dangerous place to be. And oftentimes I feel like I'm in that same place that you are, Joe, where I'm kind of asking that question, like, does this not seem more like consulting? Like, are you a business or have you become a consultant? Are you just taking any revenue opportunities you have and can you justify them long term? And it's tough, especially in the early stage, because you just have this immense pressure to have revenue, right? Because investors are so keen on the return on their investment.
Yeah, absolutely. And the thing I'd add is, again, this is for deep tech companies. So if you're outside of this categorization, that this advice may not apply. But if you're a deep tech company, you should not really be generating revenue at the pre-seed and maybe at the late seed stages, but certainly not at the pre-seed. And that's just because if you're a true deep tech company, like you need to actually commercialize the technology. You need to advance the technology. If it's already ready to go, then most of the time it's probably not a technological advancement. It's maybe, it probably fits into another category that's easier to monetize. So I think that's an early test too, is if you are sure you're a deep tech company, it's probably unlikely it's probably likely that the revenue you would see is not the revenue you want long-term.
Thank you. One more question, Kiana.
Yeah, hi. Thanks for speaking with us. Thank you for echoing the sort of revenue comment. I actually wanted to ask a question about how do you seal the deal on pre-sales? So I'm in the in-between stages where we're just about done with the product. We're starting to talk to customers, and I can't really pull the trigger on selling them a product where I'm like, okay, maybe this will be done in 2 months. We're projected to be done in 2 months. Do I take their money right now? And then you made the mention about a company, Boom, that's building sonic rockets that'll take 10 years to seal the deal, but they're already taking money. How do you navigate that space?
Yeah, I think it really depends on the product. I think in Boom's case, signing $100 million with United Airlines, $100 million deal with United Airlines is different from where most of us operate in terms of the deals we're looking to close. So that's certainly in a different category. I would say if you're looking to sell the product early and you're questioning whether or not to take the funding, I would say like simple things. If you do decide to take it, like don't spend it yet, put it aside. There are escrow solutions where you can hold it. You can also ask for like an initial deposit on the overall amount, right? And if it turns out you can't deliver or things are delayed, you can always refund that. If you're dealing with a consumer product, I've worked with a company before that actually enabled kind of the collection of anonymized credit card numbers, but did not actually charge the card until they were able to ship the product. And so in that way, you're able to demonstrate it's not just signups, because no one cares about signups. It's people actually were interested enough to input credit information, and that information is safe, but you're not physically charging until you can deliver the product. Ultimately, especially if it's only a few customers, it really comes down to trust. And so kind of ensuring them that, listen, if we can't deliver, you'll be fully refunded. That's not a problem, I think is probably more important than the dynamic of whether or not you actually take the money. I would push yourself to try to be in a position to accept the money, just because a lot of people shy away from that. And that is a pretty big milestone for the business of starting to generate revenue for the first time.
Thank you.
Of course.
Okay, you can continue, I think. No more questions.
Excellent. Okay, so on the funding side, for these deep tech companies, so we've covered a lot of these already. So I know we only have a few minutes left, so won't go into too much detail here. But just to reemphasize, when I'm looking at deep tech companies, I like to see that the founders, they make sure the market need is totally indisputable. They get creative with non-dilutive funding. A lot of the founders are first principle minded, so they approach the problem from the problem source and build from there, as opposed to using sorts of abstractions. They find a way to de-risk commercially, which we've also kind of talked about, like what are ways to demonstrate there's a market need for this. Sometimes it's revenue. Sometimes that's just commercial agreements or really strong testimonials from potential customers. And then the last part of kind of building these companies is deep tech companies have an advantage, which in a lot of ways is they can inspire in ways that software companies can't. Most of these companies are oriented around building very, very big, or they're focused on solving really, really big problems in the world. And that can be encouraging. That can help with recruiting. convincing people to join an early stage company they wouldn't ordinarily get to do. You know, I think that's a major advantage of when you're actually building these companies. You know, I'd say, you know, with the few minutes we have left, I do want to point to how things have changed on building a deep tech company over like the last decade. You know, a decade ago, I think innovation was much more siloed. A lot of the commercialization efforts, they focused on biotech at the universities. You know, programs like what Viterbi's done and others have really opened up that spigot and provided a lot of other ways to accelerate innovation, which I think has been just a fantastic change. I think a decade ago, scientists were a little more conservative with the sorts of companies they would join or projects that would take on. There just wasn't a roadmap for joining an early stage startup. I think today we're seeing talent totally explode. And plus, we're getting deep tech founders who know how to build these companies. So, I mean, I'm a deep tech founder who started an investment firm. There are plenty of deep tech founders that just go on and build more companies. So you're seeing talent explode from deep tech companies that have made it, like SpaceX and Ginkgo and many others. So that's really raising the know-how of a lot of these companies. And then I think at the later stages, I think the knock on deep tech companies traditionally is, are these companies ever going to go public? Like, are they just kind of science projects without an exit? And I think the last several years have proven that's not the case. There's more and more investors at the later stages willing to invest in these companies, willing to help them scale up, willing to help them go public. Now, as you see from this slide, I still do think there's a gap here, and that's from that founding stage to the first institutional raise. There's a ton of talent, and there's a lot of late stage capital available if you can scale your business. But I do think there's still a lack of expertise on getting from, you know, that point A to that point B. So I know we're just about at time here. Maybe I'll pause. Any final questions for today?
Well, I mean, the gap. Gap is still a big question. So that's where our teams live, right? They live in that gap at the garage. And I'm just wondering, like, aside from really great funds like yours who are making a genuine effort to give deep tech teams a chance to just make it through that like desert of funding, what other options? I mean, is grant funding something that they should just be pursuing? Is there, because I do know that that's very time consuming, right? Not everyone has the ability / the time to commit to constantly, you know, phase 1, phase 2 grant fund. Is it trying to link yourself like to things like, for instance, VSG or other programs that are going to, you know, give you a little bit of funding, take some equity, but like power boost your connections and give you some validity? Like, what other advice could you give aside from hopefully more, you know, venture funds like yours coming up?
Yeah, I mean, when I meet with any company, I try to just tell them exactly what they need to do in order to get to the next stage of development. And even if those are really, really difficult things to accomplish, because I think half the battle is just transparency in terms of knowing what they should aim for. The answer to the question you just asked is kind of all of the above, unfortunately, right? Like, if you're a deep tech company and you're hoping to build it into $1 billion company, the odds are already against you. So you kind of have to do everything to make sure you have the best option possible. Little things along the way. If you're thinking about grant funding, I think it's a great idea. Just make sure the juice is worth the squeeze. So if you've raised $1 million in financing, going after 10K grants probably isn't worth it. If you've raised $100,000 in financing, going after 1K grants probably isn't worth it, right? If you've raised no financing, it's probably worth the time to go after that 10 or 100K grant. But just make sure that, to the extent possible, you know what life looks like on the other side if you do invest this time in applying for the grants. I would spend a lot of time talking to people who have won those grants before. So you know what actually goes into them, the likelihood of success. I mean, many of you are, you know, well connected in the university ecosystem or beyond. If you can't find anyone who's ever won one of these grants, you're probably not going to win one, right? There's a lot of these that only kind of exist in the ether. So I would say, like, dig deep there and really try to find connections of groups that have been successful. I would say accelerator programs, incubators, they're helpful to a certain extent. I think a lot of the good ones will tell you to focus on your customer and your go-to-market. And I think all that's extremely important to reinforce. I think just be careful with the amount that you give away. Again, part of it is just talking to people who have gone through the program before. If the simple question is like, would you go through it again, knowing what you know today? And I think those are important to get to the next stage. And then the last thing I'd just say is, make sure if you're going to take on any financing, you understand what the terms in the agreement mean. You're not giving away too much of your company. The terms are similar to what others have in the space, and there's nothing that's going to hurt you later on. So obviously we don't have time to discuss some of those traps in term sheets today, but that's also something that's really important to know.
Well, perhaps we can get you back for another Oceanside chat and you can dive deep on these topics. It's been such a pleasure having you. And thank you. Joe Wilson also joined us for VC Angel Office Hours just last week, which is another program through the Garage for our teams. So he's been pretty busy with us. I cannot say how much I appreciate you and hope to have you back soon. Thanks everybody for joining us. Keep an eye out for the next one and enjoy your Wednesday. Bye everybody.
Oh. And last thing, I know everyone's dropping, but we are thinking of planning kind of a boot camp for deep tech founders. So I just put it in the chat. If you have a team, click on the link, feel free to apply. And we'll be in touch with more details there, but that'll be planned for later in the summer.
I will definitely share this in our newsletter
Oh, great.
VSG so that they all have it.
Awesome.
Okay.
Thank you.
Bye, Joe.
Thanks,
Bye.
Amelia.
Thanks,
Thank you,
everyone.
Joe. Thank you.
Thank you so much.